Hello and welcome everyone to webinar Balance Sheet Approach to COVID-19. I would like to state a few things for smooth proceeding of our webinar. First of all the participants who have joined us will not be able to speak or be seen on the screen unless they request to speak, which is the blue button in the lower right-hand corner. But we advise not to click that button during the presentations in order to have the presenters on the screen. And please, if you have a question or a comment, send them in message box or a request to speak during question and answer sessions, which we'll announce. Now you see on the screen our cameras, but when somebody starts to present, you will see presentation. If you want to click between presentation and live cameras, there are two buttons in the upper left-hand corner where you see live video and presentation. Presentation is grayed out right now because nobody's presenting. But when we have a presentation on the screen, you will be able to switch between two screens, live video and presentations, using these two buttons. I'd like to state that in order to listen to the audio in your own language, you should click button floor in the lower left-hand corner and select your language which you'd like to hear. Я скажу тоже по-русски, чтобы вы выбрали язык, который для вас комфортнее. Пожалуйста, нажмите.
To choose your language, please press the floor button on the left at the bottom and choose the language which is convenient for you, the most convenient.
Excuse me. I'd like to state that even though you'll be able to hear interpretation, the presentations on the screen will be only in English. So in order to view presentations in your preferred language, please click Documents button, which is on the right-hand side. You see several round buttons there, and you should click Documents, and there you see all the presentations uploaded in different languages. You will be able to download these presentations and you can open them during the presentation and read them in your own language. If you have some technical problem or comment, please message us in message box and we'll be checking them, the messages constantly, and we'll be happy to assist you. As for our dear presenters, I would like to ask everyone to keep microphone muted unless they are speaking, because there is a background noise and it makes it difficult for our interpreters to hear what others are saying. And also, please try to talk a bit. Of course, everyone talks in different speed, but try to talk a bit slower so we give our interpreters some time to interpret. Now, I think this sums it up. So if you have any question, again, please feel free to message me in message box, or I will also be checking emails, so you can also email me and I'll be happy to help you. Now I would like to hand the floor to Srini and begin the webinar session. Thank you.
Thank you, Itari. Good afternoon, good evening, and good morning, whichever part of the world globe you are connecting from. I'm Srinivas Gurajada, TTL for the task team leader for the EduCoP COP, and will be facilitating this session on balance sheet approaches in times of COVID-19. Friends, we have a packed schedule around this topic, which is gaining a lot of interest these days globally. So to kick off this event, may I request Dan Boyce, our practice manager for PULSAR program, to give his welcome remarks and inaugurate the session. Dan.
Thank you, Srini. Hello, everyone. On behalf of the WorldBank and PULSAR team, it's my pleasure to welcome all of you to this one, which is the second of a series of joint FinCoP and EduCoP virtual workshops, also known as the Smart Interactive Talks. Today's topic is the balance sheet approach in times of COVID-19. And first and foremost, I'd like to thank everyone for allocating the time in your schedules to attend this event. I know all of our schedules are not the same as they typically have been over the years. And it's great to see that everyone has made space to join us, including the speakers. In times of crisis like this COVID-19 pandemic, the timely availability of the financial and budget and fiscal information is especially critical because as governments make decisions, they could save lives in doing so. Today, we want to reflect on how to present and interpret the impact of these decisions during the crisis on the balance sheet of governments. And then in doing so, we'll also discuss and hopefully get answers to some key questions that are concerning many of us. These are questions like, what are the most likely medium-term trends in terms of the impact of COVID-19 on balance sheets? Do we already have some insights on this from the past 3 months when the crisis began? How can the balance sheet approach support longer-term thinking? How can we use it to counteract illusions and protect the government's net worth? How should public sector training curriculum incorporate this balance sheet approach so that public officials can take advantage of it? And what are the UK's experience with balance sheet review from this COVID-19 perspective? Globally, I'd like to mention some of the initiatives that are happening now. First of all, several international organizations are working on the impact of COVID-19 on financial statements. The Ipsos board, with support of Mosaic, a group of development partners, is planning to launch a tool to help to monitor the fiscal impact of COVID-19 on government financial statements. ACCA is also working on this with the World Bank on development of country studies related to the balance sheet approach to COVID-19. We in the bank will soon be releasing a policy note, impact of COVID-19 on government financial statements, with particular focus on debt. We also know that the IMF probably took the lead in this area, especially in terms of using the balance sheet and government financial statements to monitor government performance and make decisions. So today, we want this session to feed these developments. We expect to be able to draw on them as we do this work at the global level. And in doing so, I encourage all of you to share your thoughts and suggestions, especially your experiences in the country where you are working. Our next event will be on July 7th, only about 2 weeks from now. It will be on financial reporting and consolidation in times of COVID. We hope many of you will be able to join that session too. Finally, let me mention that for today, we invited our colleagues from PenPal's Treasury Community of Practice, and also some bank and IMF colleagues may be connected as observers. I hope they will also find this session interesting and enriching and useful in your work in your own organizations. Thanks to all of you again for being with us today. Hope you enjoyed the event. And with this, I declare the event open and hand it back to Srini for the further proceedings. Thank you.
Thank you very much, Dan. And that now takes us to the first technical session, which will be led by Alex Metcalf, Head of Public Policy in ACCA. Many of you know Alex. He has been a regular speaker in PULSAR program events. He'll be speaking drawing from his ongoing study on balance sheet approach to COVID-19, which Dan just now mentioned. Over to you, Alex.
Excellent. Thank you very much, Srini and Dan, for those introductions. I'm going to quickly now open up our PowerPoint for today. If you'd let me know that everyone's able to see that. Is that working, Srini?
Yes.
And maybe just a helpful reminder, the top left corner, you can navigate over to the presentation mode if you're having trouble seeing the presentation as we're making our way through. So excellent. So thank you very much for the opportunity to speak and to open with a substantive contribution now to our discussion around the balance sheet approach and the COVID-19 crisis. I'm going to spend really just something like 12 to 15 minutes to begin today's discussion. And the instruction within the agenda was to have some focus on the impact on financial statements, and I'll make sure to cover that. But also, as was covered by Dan, there's, I think, a really important piece that ACCA is going to be launching just next month, and that's being done in collaboration with colleagues from World Bank, from IFAC, and Ipsos board staff, which is going to be looking at sustainable public finances through COVID-19. That's planned to be published on the 30th of July, And really, in effect, actually, this is giving you something of a sneak peek on some of the insights that are coming through in that analysis. And as Srini said, I've had the pleasure of joining you a couple times now within the PULSAR group. But for those of you who are unaware of ACC in the background, I'll very quickly say that we are a global professional body of accountants from around the world. You'll see that we have it's now over 250,000 members in 176 countries and 500,000 students. And to my mind, this is actually why we're so well placed to be producing the kind of research that I'm about to share with you, is this international community of professional accountants we have, including 67,000 public sector members and students who are working around the world. So let's turn now to the content proper. And I think the important context for all of us in this is, of course, both the health and economic crisis that's now been unfolding for the last few months. And I think, there's many different presentations we've seen of this, some excellent data that's come through from the IMF. I'd point you to the WorldBank's Global Economic Prospects as well, the report that came out this month. And I think one of the really powerful slides that describes to us the degree to which this is truly a global crisis is the figure that's in front of you here. And this sets out not the scale of the impact, so not as a percent of GDP impact, for example, but instead the percent of economies that are in recession. And you can see that as of 2020, going back to 1871, there's no point at which we've seen this kind of global scale of recession. So there's to a degree, a universal experience to be had in this, though a lot to then discuss in terms of what this means in terms of financial statements, what it means in terms of how governments are working to respond as well. And that is what we're largely seeing here too, is a real unprecedented fiscal intervention by governments. And what I'm showing to you here on the left-hand side is what I think is some really excellent analysis from the IMF, setting out the announced fiscal measures across the G20 countries and presenting those as a percent of GDP. And maybe this is actually a good place to jump in with some of the impacts that we do see on financial statements, both in terms of the implications of the interventions, but also in terms of what we're seeing as a result of changes in the economic picture. And if you look across the financial statements, if you look at the statement of financial position and our focus today on balance sheets, statement of financial performance and cash flow statements, really there are effects that are playing out across all of these different areas. So in revenue, we could actually see effects on both sides of this. So in some economies, in really almost all economies, we're going to see falls in tax receipts, for example. But we're also going to see potentially some increases in international aid or donations coming into government that need to be recorded. Expenses, really, this is one where this is what our economic colleagues might call automatic stabilizers. So responses to recession of things like increases in unemployment payments or social benefits. An obvious one here being healthcare spending as well, and additional expenses that are resulting from the pandemic. Moving to assets and liabilities, though, I think this is where we can really focus our attention. And I think Srini and Dan are quite right to say that there's a significant conversation happening globally about the role of public sector balance sheets in properly understanding this crisis. So on the first slide of this, on assets, there's going to be significant change to liquidity positions, to drops in cash. And I think there's an important piece to be done here around managing liquidity as well as debt management, which turns us, of course, to our liabilities. And of course, we traditionally talk about public sector borrowing as a key economic indicator for the kind of fiscal health of countries. But there's very large scale interventions that we're now seeing in the area of loan guarantees, of equity injections, and of what the IMF has described here, to turn us back to the slide, as below the line interventions. And what you can see is that from this global fiscal response of around $9 trillion US, the above the line interventions, so some of the things that I've mentioned here that will impact our financial statements, like transfers to firms and households and healthcare spend, the above the line interventions are representing about 4.4 trillion US dollars, whereas the below the line interventions are actually making up the majority by the IMF's analysis. is things like loan guarantees or equity injections. And I think there's some very interesting implications to that. And what I direct you to as well is the IMF policy tracker that has a link there that you can hopefully click through in the documents, which sets out a quite comprehensive view of the different policy responses that have been occurring across 196 countries. So a very useful resource there. But from my view, because we have this below the line intervention, not actually making up the majority, let's dive into a specific example before I make a kind of contested point for us to debate. And that's about the need to take the net worth perspective here. And you'll see that there's some interesting analysis presented in front of you here. And this is actually coming from the work that we're doing in this Sustainable Public Finances report, where we're covering 10 different economies, looking at their net worth positions. So the difference between their assets less liabilities, the remaining net worth that they might have, with the kind of fixed assumption here that will return to 2019 levels of activity by the time we get to 2022. On the top left side of this particular example I'm showing you with Turkey, you'll see the 2019 position of gross liabilities as well as financial and produced assets, which results in a slightly negative net worth for Turkey going into this crisis. And then we've used a number of sources to come together to set out scenarios of Turkey's fiscal policy response as one of these examples across the 10 countries in this initial study that we're doing. That's just given the degree of uncertainty that we have in how long this is going to last and what it's going to mean for public sector balance sheets. And you'll see the forecast, given some of the assumptions we have, that goes out to 2022. Giving you a kind of more comprehensive view of this, here are the 10 different countries that we've been able to cover in this initial study, some of which are going into the crisis with quite strong net worth positions, so they actually have positive, more assets than liabilities that are going into the crisis. South Africa is actually sitting around the neutral mark here. But I think the interesting piece with this is the kind of size of the impact of what we've captured in these different scenarios of the fiscal policy interventions. And I think the real point to make here is that we're really only including the very core of the newly announced fiscal policy measures. So this isn't including things like automatic stabilizers, like the increase, the fall in tax receipts that I mentioned to you. This is really just that initial response. So really what this means for us then is we have this quite kind of combined challenging context that we're working through at the moment. And that includes the deterioration of public finances, as you can see from a kind of quick snapshot of some of the analysis that's going to be coming out in that report in late July. This is going to be fueled even more so by the unprecedented economic downturn. But a real challenge that I think is important for us as a group of professional accountants and what it means in terms of public finances is how we're actually managing unaccounted for policy interventions, like those below the line interventions, as well as different fiscal risks. And this is the contention that I thought was coming up before, which is that in my view, it's actually time that we drop debt to GDP ratios as a key economic metric for us to come out the other side of this crisis in a sustainable manner. And when I say that it's time to drop it, what I mean is we need to be dropping debt to GDP when we think about our fiscal rules. So we actually need to have a much more comprehensive view of what you might call the fiscal firepower that's available to us. At the same time, we need to be using more comprehensive financial metrics in making decisions around government spend. So there's really, in my view, no scope now for us to you could say, actually fooling ourselves in the financial position. So focusing on off-balance sheet liabilities, for example, other fiscal illusions like accumulating debt within state-owned enterprises or having a fire sale of assets. And finally, I think there's another point here, which is around the need to really buttress and to support our transparency and accountability work, because so much of getting out of this crisis is actually going to be about managing public trust and accurately and comprehensively reporting financial information. That's setting out then that we need to move away from just our debt to GDP ratios and move towards something more like a comprehensive view of public sector net worth instead. And the slide that you can see in front of you here is setting out across a number of economies work that was done by the IMF in 2018. It was published in 2018, where the top above the line of zero, you're seeing different financial assets. Below is the amount of liabilities, and the black line is showing you the net worth position of each of those countries. And we need to now include public assets and non-debt liabilities in supporting our thinking as we move away from what might be called just bridging the gap in this initial response, trying to maintain the productive capacity of our economies to the point where we're actually thinking much more strategically and trying to shape our future as well. And that actually leads me to a final slide and more just kind of an open question for us as we continue and we hear from other speakers and have a Q&A at the end, which is really transitioning towards this point in a journey through the pandemic of having to make some big strategic choices. Because up until now, a lot of the fiscal policy interventions that we've seen have actually been about just maintaining status quo as best as possible. So putting an economy on life support with the hope that it will return back to our previous levels of activity once the pandemic has passed. What I'm showing you here is actually a survey that was published by the World Economic Forum. And they've asked a sample across Germany, the UK, and the US what they're planning to do once restrictions are lifted and how that's going to be affecting their behavior. So are any of these within this list areas that they'll avoid? And you'll see things like music theaters, pubs, gyms, restaurants. Across all of these countries, they're at least suggesting that there will be changes in behavior. And I'd contend that there's a really important exercise for us now as we make these big strategic decisions to kind of expand our toolkit for success and have a really comprehensive view of the financial information that can be brought to bear in trying to attack this crisis. So with that, I'll leave you with a slide of ways in which you can get in touch and hopefully engage in the reports and the work that we're doing in this area. And I'll hand back to Srini to continue today's conversation. So thank you very much, everyone.
Thanks, Alex. And what you're suggesting is the dropping of debt to GDP sounds like as if it's the answer of accountants to use financial reporting instead of the default way economists would analyze the process. I'm so glad that you mentioned that and the way this came up, the session came up. As we transition to the next session, so Dan mentioned at the beginning, colleagues, that we are putting together a policy note on this subject. So the next session would be anchored around that policy note with on balance sheet approach and use of financial reporting in COVID-19 environment with particular focus on government debt. So this will be led by Professor Frans from University of Amsterdam, who is one of the key authors of this policy note that we are putting together, also a global Ipsos expert, and by Dimitri, team leader for FinCoP from the bank. Together they lead the presentation, and towards the end of the presentation, I'll come with some comments and closing remarks on that particular section before we transition to UK experience. Over to Dimitri, followed by Frans.
Thank you, Srini. Good afternoon, good morning, everyone. On behalf of PULSAR team, we are glad to share with you the preliminary results of a policy note we are working right now, entitled Government Financial Reporting in Times of COVID-19 Pandemic. As you all know, the economic shock of the coronavirus outbreak is having an unprecedented impact of public finances. Most of the governments are implementing costly and all kinds of responses to fight the pandemic, while most of the revenues coming from different sources are sharply going down. In this context, communicating the financial consequences of COVID-19 to all stakeholders in a timely manner is important to create enduring broad support. Thus, the main objective of this policy note is to provide some reflection on how the governments could make use of existing financial reporting system during the pandemic and what are the opportunities to improve the system in post-crisis environment. The paper also seeks to share some insight into the impact of the pandemic on government financial performance, position and cash flow, provide guidelines on how the balance sheet approach can support long-term thinking while protecting net worth of the governments, and finally, share international experience on communication of COVID-19 impact. In this slide, we can see that the main reason for financial reporting, either cash or accrual, during any crisis is to provide a comprehensive overview of the ongoing impact. In our case, resulted from COVID-19 pandemic, and enable government to make the decisions. For that, it's important to ensure that the financial statements are issued in a timely manner, within 6 months, but ideally within 3 months period after the end of the fiscal year. Moreover, another recommendation is to promote timely preparation and assurance of interim financial reporting, saying they could be monthly or even weekly or daily, to ensure that the policymakers are still able to timely decision making in terms of the pandemic response. In these slides, and in terms of the system and next steps, the note will include the following recommendation: use of existing IFMIS and other IT tools to the maximum extent to ensure that the financial information is produced in reliable and timely fashion. Continue moving with the implementation of accrual accounting system, ideally aligned with IPSAS, it's another priority. Promote coordination with the supreme audit institutions in your respective countries to ensure the proper accountability mechanisms are in place, and especially during the crisis time. Next one, please. It's also important for all of us to follow up on the existing relevant publications and pronouncements, such as those issued by the International Public Sector Accounting Standard Board. The recommended practice guideline number 2, also known as that RPG, on financial statement disclosure analysis, issued by the IPSAS board in July of 2013, is one of them. But you could also find an interesting most recent publication entitled COVID-19 Relevant IPSAS Board Accounting Guidance, published in April of this year. This would be all on my side for now. I will hand over the floor to Franz and Srini, who will share with you further findings and insights of this note. Thank you.
Franz, you're
muted.
Another recommended practice guideline from the IPSAS board is particularly relevant at this point in time, being the one about the long-term fiscal sustainability. Because financial statements, budget, even multi-year budget, only that covers the next few years. Long-term fiscal sustainability goes out maybe even 70 or 80 or 100 years in the future, and then calculates what the perspective would be of the development of the net worth of the government, of the surplus or the deficit. And a great example is actually the one that we see in the financial report of the United States government. And here you see the one that was issued in February this year, where the thick black line is the total receipts, and the thin blue line here is total spending. So the deficit is going to be enormous. It's actually demonstrating the lack of sustainability of public finance. So the recommendation from the IPSAS board is for all governments to come up with this long-term fiscal sustainability analysis. Many government financial statements are still financial statements of the central government only, the one that we see here in the middle, the national government financial statements. But to have a more comprehensive view on the public finances, we need not just the national government, but also the local governments included. That's what we call in GFS, government finance statistics, the general government sector. Because there may also be liabilities, public debt in there. So a more complete view you get when you take the general government sector. Ipsos is saying, well, we look at the accountability, we want to include all of the controlled assets. So if there are public corporations, they should also be included in the Ipsos consolidated financial statements, so including the controlling and all the controlled entities. And the most comprehensive picture is painted when we take all of them put together, and then we have the whole of government financial statements, like the United Kingdom is publishing each year. So make sure you have the systems and procedures that allow consolidations at different levels of aggregation, including the whole of government. Now, in times of the COVID-19 crisis, it's also important to carry out an assessment of the business continuity and the going concern. And you may say, well, for a sovereign government, there is never really a going concern issue, but for other government-related entities, for lower levels of governments, like in the United States, lower levels of government can actually go bankrupt. So that's why it's important to face the potential new emergency situation, and without affecting its service capability, that the government doesn't have to reduce its services, and allowing staff to work remotely. We have never been preparing for a thing like this, but in an analysis like this, that's apparently also important. If going concern assumption is not met, that would mean that the whole accounting policies that are applied would be heavily affected. So that's also an important analysis now. So where do we consider that the COVID-19 may have an impact on the government's financial statements? And how can the balance sheet be impacted by the crisis? Well, first of all, the impairment of assets. So that is impairment of physical assets that may have a decrease in their value, but it may also be financial assets, so receivables, tax receivables, for instance. If there are doubtful debtors, then you have to impair, and that would, under accrual accounting, hit the deficit for the year right away, just to make clear that the receivables are not anymore at their full face value. The most important item, mostly on government's balance sheet, public debt, will definitely increase in many countries, and even though they're still quite high, as caused by the financial crisis in 2008 and 2009. So luckily, interest rates are very low, which then makes that the debt service is still reasonable, but the public debt figure will actually go through the roof. Then we have provisions. Governments are easily giving guarantees, and in good times that's no problem because they are never really called upon. But now that in times of trouble, the guarantees will actually be called upon, for instance, by lenders to state-owned enterprises that received a guarantee by government, and then suddenly the contingent liabilities, the guarantees, turn into provisions, and then IPSUS 19 kicks in. And then you have to recognize the liability, the provision on the balance sheet, and of course, that then hits right away the deficit for the year. So the one at the bottom, net assets equity, that's what Dan already referred to as the net worth. Alex as well, net worth. So that is the net assets equity. That's the terminology that IPSUS uses. But in these days, it's usually a little bit of a misnomer, as Alex has indicated, because it's very often a net liability, liabilities exceeding the assets of the government. There is a danger that arrears will increase, so we will not just have accounts payable, but we will also have accounts payable that are overdue. They should have been paid, but are not yet paid, and so that's why it's important to monitor arrears. Why is it so important? Because it means if there are arrears, that the government actually keeps the service providers, the vendors waiting, which may hurt the economy. So rather pay more quickly to make sure that the companies keep going. Then pension liabilities, they are in many governments already even larger than the public debt. If you properly account for them on a full accrual basis, actuarial calculation, they may even exceed public debt, and probably more so because central banks keep interest rates low, but that means that the pension liability increases. Over to you, Srini.
Thanks, Franz. Franz brilliantly summarized the balance sheet impact through these 6 themes. Let me take a step back and from the perspective of the paper and mention, like, as you could see, colleagues, so most of the narrative is about line items and information on accrual basis. So one of the fundamental premises for our paper on COVID-19 is also to say that many developing countries which are on cash basis still will have a lot of information which will be useful for analysis of financial management and financial statements to inform policy making. In true sense, very few countries are truly accrual accounting, and very rarely do you find entirely cash basis financial statement. So it's a continuum. The stage in which a country and the accounting system in government exists determines the quality of analysis that's possible using the financial statements. Next slide, Franz. So let me now take you through, like, this is a bigger picture chart using a kind of an accrual accounting structure to describe how financial statements would interact with each other. Typically, like the cash flow statement, the statement of financial performance, the statement of financial position, and changes to net assets or equity. As Franz mentioned, the concept of net worth itself is now probably a misnomer. It's always the liabilities exceeding the assets, and a gap existing in governments is normally the way it operates. I wouldn't take you through this entire slide. This is more to depict the flow as such, but let me highlight a few basic line items, drawing from what Franz mentioned, going through the key statements. Let's take the statement of financial position. So all of us agree that revenues are going to be really going down. Taxes, fees, other revenues, everything will go down due to COVID in most countries. VAT, which accounts for a large part of this deterioration, it can even turn to be negative because you may be paying back more to the people than what you're collecting on account of VAT receipts, which means there's a negative VAT receipt. So this is a kind of an overall picture. So what can really be different probably on the revenue side is only perhaps a recipient of a government entity which is receiving transfer from another government entity. For example, a subnational government receives some transfer from the central government. That's one area which probably can increase, but otherwise revenues would also decrease. Expenses. So usually one would treat expenses as what would happen during COVID-19. Do expenses go up or go down? It typically will be a mixed result in most countries. The reason being, like with the traditional logic that if revenues are going to fall, expenses in aggregate have to reduce. That's true. But at the same time, governments are going to spend more, particularly in some areas. For example, public health would be a huge additional expenditure, unemployment benefits, social security, subsidies, some of which France and Alex already mentioned. So these would actually go up. So what would be the cumulative effect of all this? The cumulative effect would definitely be the expenditure overall going up. One thing which we don't expect as to go up significantly is the finance charges. France mentioned that low interest rates would contribute to that. I would also add that in many developing countries, you also get the G20 debt deferment process, which kicks in right now during COVID-19 environment, which could affect the level of expenditure charged on account of interest in a particular year. So the total interest rates could be kept low. So the net of all this would be that the statement of financial performance is going to report a very high deficit. So it's a big negative. Let's move to the current assets, to the balance sheet, the statement of financial position. So in general, we all know that the current assets, cash, receivables, these will all be going down because we are going to spend a lot. Governments are going to spend a lot. Fixed assets, property, plant, and equipment. You may not see many new fixed assets coming into the balance sheets quickly because public investments, capital works in the government are actually going slower these days when compared to what otherwise it would be, which would also trigger the need for impairment testing generally on the PPE as such. The biggest challenge, as already mentioned, is the liability side with respect to government debt, provisions, and pension liability. So which makes the overall net worth something very negative. Now, the fundamental question for policymakers is, yes, as also depicted by Alex. So if the net worth is in the long run going to be so negative, the impact of COVID, then how are we really going to position our policy initiatives? So how should policy making be influenced to make sure that these decisions are sustainable in the long run? The last slide, the next one, France. So let's go to some typical accounting things, areas which would influence in COVID-19. Let's take like one fundamental question. Many of us accountants, we know this term, the event being an adjusting event or a non-adjusting event. We are trying to answer this question. Is COVID-19 an adjusting event or a non-adjusting event in financial statements? So in our opinion, by 2019, if year is ending on December 2019, for example, and you are now preparing the financial statements, COVID-19 did come up in 2019, but nobody really knew the seriousness, severity, and impact of COVID-19 at that point of time. So when you prepare the financial statements now, as on December, you need to take into consideration only the conditions existing then, which would mean the subsequent events, the events now which we know, need not be reflected into the line items into the financial statements. But what one can do probably is to provide a narrative in the notes that there are subsequent events, which is a pandemic, and if possible, also assess the financial impact of that pandemic and present in the financial statements. Moving forward, assuming you are right now preparing financial statements for ending March or ending June, then what would actually happen? Then probably the storyline is slightly different. This can be partially treated as adjusting events, which means your assets and liabilities are significantly different because you know that the values have changed. We all know the enormity of this pandemic. So this need to be very carefully organized and addressed in consultation with the auditors, because assessment of impact itself is a kind of an evolving storyline. Franz already mentioned about arrears, so I wouldn't really go much into it. Arrears are typically the short-term payables, the kind of what the government needs to pay. One key point is very rarely countries have robust IT systems, in particularly in developing world, to calculate and get to know arrears. Often the arrears figure boils down to what in an annual IMF mission along with the World Bank, they agree with the Ministry of Finance, they decide, they announce it together as the arrears and make calculations. So this is which means the credibility of the number itself is questionable from normal accounting systems, the IFMIS system, financial management system. So stronger systems need to be in place to position this in the process. So the next point I would like to mention is that, is it an extraordinary item? Is COVID-19 for financial statements an extraordinary item? Yes, partially we can treat it as extraordinary item, but the accountants and policymakers should guard from this risk of considering all other normal activities also under the guise or the title of COVID and starting to consider them as extraordinary. So part of them do satisfy extraordinary, but not every item. Guarantees and public debt and contingent liabilities. So contingent liabilities, COVID-19 brings a lot of contingent liabilities. So many things are uncertain. Now, particularly with PPPs in public-private partnerships in place. So many of these arrangements may result in, for example, the airports, the transport highways not being the assets which they otherwise would have been. So these could translate into a liability in future, since most often the liability is the certainty is not high. We will not quantify it and bring it into the kind of an balance sheet, but treat it as a contingent liability and disclose it. If the probability of outflow is very remote, even disclosure is perhaps not required. So this is a care area one need to carefully work the contingent liabilities and guarantees while presenting into the financial statements. The last point I would like to mention is essentially about sovereign wealth funds and the rainy day funds. So sovereign wealth funds are state-owned big investments. Often they don't figure in the government financial statements. It's not necessarily secret, but the whole intention is to keep park funds separately for the rainy day. And now governments may bring these funds into the financial statements because they plow back during COVID-19. If government is taking funds from the rainy day funds into the financial statements, the inflow, the amount which is received, which is cash inflow for the government, need to definitely be reported into the financial statements and disclosed how it's going to come up. The one important area policymakers need to also consider is sovereign wealth funds are borrowings from our future generations. So what would happen if we are taking money from these rainy day funds? The impact, how badly the future generations would be ready for as times progress, need to be understood by policymakers carefully in configuring the overall policy responses. So in summary, our paper concludes that balance sheet approach to COVID-19 fiscal policy making will be very effective if certain conditions are met. What are the conditions? The financial statements should be good, credible, and robust to present the right kind of information that's required for decision makers, and they should be audited to improve further the credibility. If done well, the financial statements will emerge as a default choice by presidents, prime ministers, and finance ministers for policy decisions. This will also strengthen the typical economist's viewpoint to financial decision making by backing them with sound and credible accounting data on an objective basis. So that's what our the key findings of our paper are, which will go public soon, and we'll share with you once that comes up. So I thank both my colleagues Franz and Dimitri who presented this session, And as we move to the next session, so we already heard some country experiences, but right now we are trying to dive a little bit deep into one country, United Kingdom, and its experiences with the balance sheet analysis. We have two colleagues from HM Treasury, Vicky Rock and Costanza. I'll invite both of them to present UK experiences. Vicky.
Thank you so much, and thank you for inviting us to be here today. I'll just introduce UK's experience. So first of all, when it comes to balance sheet management, it's something that the UK has been working on for quite a long time. And in fact, you can go back 10 years or perhaps even 20 years to when we first introduced accrual accounting. And it has taken a lot of time over that period for us to get to the point of, first of all, laying the foundation to have, excellent balance sheet information, to then start to move away from using it purely, for information, to using it in a much more forward-looking way to help us with our decision making. And so when I think back to over the last few years, what have been some of the drivers of the change in the UK? I mean, one of the first might be the whole of government accounts. We started publishing them 10 years ago, and it started as a transparency exercise on bringing together for the first time the whole of the government balance sheet. So all of central government, all of local government, everything within scope of government financial statistics. And we did it using accrual accounting standards. And it showed us things that we hadn't, ever appreciated before about just how much risk was held on our balance sheet, but also how much opportunity as well. And it's interesting looking back at that period from sort of 2010 onwards. We were dealing with the fallout of the global financial crisis, and the whole of government accounts was a really essential transparency tool for showing the state of the UK public finances. And it was useful for engaging with rating agencies. It was useful for thinking about what our risk appetite was for the liabilities which we were taking on. And now, in dealing with the response of COVID, actually a lot of those disciplines and experiences are proving to be very, very valuable. It was very interesting listening to the earlier presentations and recognizing so many of the issues that they raised. When I think about our year-end accounts for this March, we are preparing all of the individual entity accounts at the moment, and later we'll consolidate it to the whole of government picture. But in each individual entity, we are seeing going concern issues or credit losses, changes to asset valuations, more provisions on the balance sheet, more guarantees on the balance sheet, a drive to make prompt payments to support the supply chain, even when services have been disrupted. And so, everything that Franz relayed as those considerations, they're all ones that we've had to apply within the UK and apply at every level. And then once you have those reliable financial statements, I think the challenge is then to utilize them to their full extent. And I think that this is where you can see the linkages to Alex Metcalf's presentation about looking at public sector net worth, which is that if you have this very rich information on balance sheet, and it's taking a lot of time and effort and cost to compile it, you want to maximize the benefit of that. And that was one of the challenges that we really had in the UK. And our Supreme Audit Institution, our Parliament, others called for us to make greater use of our balance sheet data in managing the public finances. And that's one of the key factors that led to us launching a balance sheet review. And the purpose of the balance sheet review is to have a much more systematic approach to reviewing our assets, disposing of those that no longer serve a public purpose, looking at the return on our assets for those ones that are retained, and reducing the costs and risks associated with liabilities, and actually setting a much higher bar for when do we enter into liabilities. Is there a good reason? Is there a good exit strategy? Is this the best way to achieve a policy aim? And so from 2017, when we launched the balance sheet review, until today, we were using Git to start to strengthen the balance sheet, to sort of as part of the recovery from the global financial crisis. And it had a lot of successes around reducing inflation exposure, controlling contingent liabilities, getting much more regular reporting on the balance sheet, and being able to use it increasingly for decision making. And that's all the background for where we got to. And fast forward to today, our big challenge now is to use that balance sheet data and to use that balance sheet insight, information, the projections that we have as well, in order to formulate the UK government's response to COVID-19. So the challenge there is to use it not just to tell us what has happened, but also to use it to say, what is the best intervention that we can make, and how can we utilise our balance sheet to good effect, and how can we protect our balance sheet from undue pressure that puts it in an unsustainable position. So I'm going to pause there and hand over to my colleague Costanza to talk us through what we're seeing right now in the balance sheet review in relation to COVID-19. Costanza.
Thank you, Vicky, for the great introduction. So, hello, everyone. So I'm going to talk you through the slides that Vicky so greatly introduced. Sorry. So going for the first slide. So this is something that Vicky already has touched upon. So I'm going to just like summarize, but basically, why is the UK carrying out a balance sheet review? So firstly, we've seen that increasingly in other countries, we're moving towards more balance sheet intervention in macroeconomic policy. So for example, loans and guarantees. And of course, the more balance sheet intervention you have, the more there is an increased fiscal risk for government on its size of the balance sheet. The second reason is because we have an increasing focus on balance sheet in managing the public financing. So we ask ourselves questions like, is this net worth strengthening or is it net worth weakening? And also this gives us an opportunity to think about how we best manage our assets and liability and can strengthen our long-run fiscal sustainability. The last point is what Vicky was saying before about the whole of government accounts. We have this amazing data now available to us, and we want to make use of it. And we want to understand from this data how we can best use the balance sheet to actually like improve our net worth in the long run. And also this data is being used to increase the awareness of the public sector balance sheet by independent bodies. So this slide, I always find it quite interesting. So this is our all of government accounts in a graph from the early 2000 to 2017. And this is based from the whole of government accounts and is divided in, on the top end side is like assets. So we have financial corporation assets in dark blue and other assets in light blue. And the bottom end side is liabilities. And we have pensions in yellow, other liabilities in pink, and then in red, financial public corporation liabilities. And the black line you see is the net worth. So as you can see, there is a quite clear trend that up until 2007, we had a net liability position, but our net worth was more or less always the same. And our balance sheet, I would say, was quite contained. while after 2007, you see that our balance sheet massively increased, especially on financial assets and liabilities. So while initially this doesn't have an impact on net worth, it does have an impact on the size of our balance sheet. What we see like from 2007 till now is that we really put a lot of effort in like selling back those assets and liability that we acquired after the financial crisis from the financial sector. While that has a sort of impact on reducing slightly the balance sheet, we've seen that actually our net worth has decreased. So if we look from like 2007 to like 2017, our net worth position is significantly worse. While our balance sheet, yes, is still bigger, but it has decreased after the financial crisis. So in a way, while we sold a lot of the assets, our liabilities sort of stay constant or like diminished, but not as much as our assets. Why is this graph so important? Because we don't have now a graph of what this looks like in terms of COVID, but we could imagine that our balance sheet will increase as well after 2020 because of the several interventions that we're doing at a UK level. And at the same time, we're at a way worse position net worth wise than we used to be pre-financial crisis. So our position is different. What we do know now, though, is that we do know this data. So we do know where we stand, so we can do something about it, and we can try to, like, if anything, make sure that our net worth doesn't decrease again. I'll have to flag that this is from all of government accounts, but for example, the UK Office of National Statistics also has increased their publication of this data, and they do publish it quite often, and is in line and compliant with the Government Finance Statistic Manual of 2014, and you can find it online. So what happened this year from March? So as several other countries, we have provided unprecedented support to the economy, and this, of course, has impacted our finances. However, we know that the cost of an action would have been higher. So our economic response to COVID-19 has been quite focused in making sure the economy survives through the crisis, keeping as many people as possible in their existing jobs, supporting viable businesses, and protect the income of the most vulnerable. And then we wanted to ensure that the productive capacity of our economy is still, like, quite strong and enable a recovery, quite swift recovery, as much as we can. The impact of our finances is quite significant. So the Office for Budget Responsibility, which is an independent body, has said that the cost of the direct cost of government to the response of coronavirus will be above 120 billions of pounds in 2020-21 only. On top of this, there is also there has also been a lot of support in terms of, like, loans and guarantees, and we know still from Office of Budget Responsibility data that the total exposure of these schemes is over 300 billion, and the expected costs from loans and guarantees are expected to be 5 billion in 2021. However, as I said earlier, our response was very targeted for recovery, and we know as a fact that if we didn't take these steps, we would have actually, the effect of COVID would have left a permanent scars in our economy. Although we are spending unprecedented amounts, the consensus both in government and outside among external economists is that not spending at this level would have caused even further damage and scarred the economy. So what we can do in times of COVID, how we can ensure that we apply good balance sheet principles. So firstly, what we try to do is transparency is key, and getting good data is very important. So we really focus from March to ensuring that we have regular reporting on exposures and take-ups, for example, from our UK Development Bank from SMEs and our UK Central Bank, and also private lenders. It was quite difficult at the beginning because we were announcing a lot of new schemes at an unprecedented pace. However, we ensured, thanks to our policy teams at the UK Treasury, to have direct line of communication with the private lenders to have quite timely data on how the schemes were reacting in terms of like how many businesses were picking up these loans, in which sectors, and so forth. The UK Central Bank, the UK Treasury and other ministries publish statistics on coronavirus support in the public domain quite often. So I would say almost weekly, if not more. The Office for Budget Responsibility, again, publish and updates regularly the coronavirus analysis. What we're trying to do also is to actually build up our analytical and institutional capability. So we know that we have certain bodies that are very good at doing stress testing of our guarantees portfolio. For example, the UK Central Bank is one of those bodies. But we're also trying to build capability to perform stress testing across the entirety of government portfolio. And we're increasing also our expertise to manage and invest in equity. At a central level, we're starting to collect data from sector, industry, firm level in terms of like their credit default. And also we're getting advisory on how to do credit risk analysis from experts. Lastly, what do we do in terms of in the medium to long run when there is a need to create the right environment to manage an expanded balance sheet? The first thing we can do is to ensure that interventions are value for money for taxpayers. And to do so, we might need to sometimes impose conditions or constraints for accessing support. For example, for some of our schemes of guarantees, we impose condition on dividends or on senior pay. But we know that interventions that support economic growth are good for the balance sheet, so we should be doing that. What are the risks of an extended balance sheet? So, of course, intervention will increase debt, so our liability side of the balance sheet will increase. Also, because our balance sheet will expand and we will end up with more unconventional assets and liabilities, the balance sheet might become more volatile, and also our fiscal metrics might become more volatile. Because we're sometimes imposing conditions on schemes, this might mean that some businesses might be classified into the public sector, and this might impact our public sector balance sheet and our national statistics. So how we ensure that we mitigate this risk? So this can be done with our fiscal policy. And this is where we see where a combination of where like good balance sheet data can meet good fiscal policies, and the two can actually go together. So the fiscal framework could reflect on these expanded balance sheet impacts. This is something that we've done after the financial crisis. Fiscal risk associated with this loan and businesses we lend to will be in scope for the risk function at the UK Treasury and will be reviewed. So this will make the end of my presentation. Thank you for listening.
Thank you very much, Costanza and Vicky. In fact, the UK experiences are so interesting also because UK is one of the biggest success stories in terms of preparation of the whole of government account itself. And COVID presents this interesting times to understand how it's used and what would be the way forward. So with that, we come to the session relating to question and answers, which would be managed by our colleagues, Arman, Program Manager for PULSAR, and Patrick, co-TTL, co-task team leader for the EduCoP. I hand over to Arman and Patrick to manage the question and answers, and I would also request Arman to the end of this question and answer section, summarize and close the event for the day. Over to Arman.
Thank you, Srini. Thank you for very good presentations. So we're opening the floor for questions. Please just press the request to speak button. We already started receiving questions, and one broader one, and with Patrick will moderate. One broader one is if there are no consolidated financial statements are prepared, how can the balance sheet approach be used? This is first broader question. Who would like to go first? Alex, is it fine with you?
Sorry, Arman, I was trying to pull up the messaging board here to see the questions. Do you mind repeating it?
Yes, the question, if the countries, because the majority of PULSAR countries, they do not have still consolidated financial statements. So if they do not have consolidated financial statements, how far the balance sheet approach can be used, and what is the applicability of balance sheet approach model?
Yes, I think, well, it's a very valid point, which I think to a degree, Srini and colleagues began to address this, saying that there is actually a spectrum here. There is no kind of absolute of cash basis or accrual, and it's understanding, one, that actually moving along that spectrum will be helpful, but also then making use of what you do have in the position you currently are, in terms of if that's an asset register, for example, maybe that's the limitation of where you are, but that's still helpful in terms of something like a fire sale of assets. So I know the focus in my presentation was around trying to combat fiscal illusions, for example, and I think even outside of what information you have available, though that's incredibly important as a prerequisite, applying this thinking is still really helpful too. So maybe you don't have an exact figure on what the implication will be, but you can apply the balance sheet approach and the thinking behind it in trying to inform some of that decision making as well.
Alex, France, would like just to add, and Vicky? Can you unmute, please, France? If you can unmute, please, France. Okay, Vicky will go first, then please.
Thank you. Just to say that I agree with Alex, which is you don't need consolidated financial statements to identify your handful of top balance sheet risks that you need to monitor most closely. So within the UK, we have certain balance sheet risks that we monitor on a monthly basis. We do not have consolidated financial statements on a monthly basis. So you could pick your top 10, your top 20, you could look at your data sources on those, and you would be mirroring a lot of the UK's approach, even if you just focused on your handful of top risks.
Thank you. Thank you very much, Vicky. So the next question came from Rafi, whether the country should keep separately the COVID-19 related expenses and register them using separate accounts in order to see the effect of the pandemic separately. For example, he refers to the social expenses as an example. Just to pick up on that one. Yes, Franz.
Oh.
Yeah, distinguishing the COVID-19 related impact on financial statements, saying, well, this particular reduction in revenue, that's what we blame on the COVID. This particular increase in expenses, that we claim on COVID, and then reporting it separately, well, that is very unlikely to be a reliable estimate. So for financial statements, if it's not a reliable determination of the amount, then just don't try to make that distinction. And that's why Srini also emphasized that there will be many changes in the figures that have to do with COVID-19, but cannot really be labeled as such. Of course, yes, purchasing face masks, yes, that's a clear case. But for many other items, it's too fuzzy as to whether it's COVID related. So in financial statements showing financial performance, cash flow statements, we would not typically recommend it to show it separately.
Thank you, Franz. Vicky?
Thank you. It's just to say I very much agree with Franz. There will be a small number of high value items which you can identify. You will have a whole load of other things where it's quite grey, where you've redeployed staff, they're working on mixed priorities. I find that there's a lot of appetite for that information from Parliament. It is an area, I think, where the financial statements struggle to meet demand. If you
Vicky, we have lost you probably. Vicky? Okay, Alex, would you like just to reflect on that one?
Sure. I think this has actually been covered off quite effectively by Franz and Vicky, which is to say, maybe expanding on her point as she was cut off, I think there is significant demand for this information, and it's something that policymakers are going to have to reflect on how we best try and serve that demand. But I'm not sure that the financial statements are going to be an accurate way to try and meet that. Hopefully that's the point you were trying to conclude with, Vicky.
Thanks, Alex and Vicky. Patrick, would like just to... Yeah. Patrick, you are muted, probably hard muted from the computer. You are still muted, Patrick. Okay, probably, Patrick, there is a mic, could you unmute? So there is another question came from Karen. So he asks how to increase the demand for financial information. So this is the substance of the question, and the balance sheet approach, because as we're discussing, this is going to have major impact on the financial position and performance of the countries. In many governments, in many governments, they just simply do not want to politically to accept it and to take this liability and politically have negative impact using balance sheet approach in this time. So what is the reason? How we are going to justify and help the governments just to move towards the balance sheet approach? First, Alex, I understand you just ready, please.
Sure, I can jump in to start us off on this one anyway, which is to say we did have a publication that we spoke to a similar event in the recent past year, where our recommendation there is that you build in some of the more politically difficult aspects of financial reporting into a later part of implementation. So it is there, but obviously that's a recommendation that's helpful for those who are on that journey. But at the moment, this is much more of a challenge. This is something that has an immediate reporting need instead. And in the end, we are going to be civil servants who are beholden to political masters. So it's quite a challenging question of how you do that well. I think the best way to approach it, though, in the immediate term of the crisis, is to frame it around how it provides decision useful information. And at an initial step, this is at the very least about how it can improve the decision making within government. And that the preference there would still be one of transparency and accountability, of course. But I think that's the kind of the wedge, if you'd like, in opening up that conversation, is showing how there's decision useful information created through these financial statements, and that the politicians should be using those in informing their decision making to support long-term fiscal sustainability of the public sector.
Thank you, Alex. Franz, how to convince governments? Political leadership current.
Being transparent and showing the huge impact that the crisis is having on the government's public finances, that should be helpful in justifying drastic measures. So if you don't show the impact on the assets and the liabilities, on the net worth of the government, on the accruals, surplus and deficit, how can you convince others that drastic measures are necessary? So I think it should be helpful for politicians.
And maybe one other point I can jump in on, if Vicky's not able to join us, she made this during her presentation and has raised it before, that if you look at the UK from the global financial crisis, being able to refer to these full accrual statements meant that credit rating agencies were actually given a degree of certainty too. So maybe looking to international organizations, looking to the kind of broader credit market is another way that you can look to convince your political colleagues that this is the right way forward.
Sorry, I might just add, Vicky froze, so she sends apologies. That, yeah, I agree with Franz and Alex. I think just knowing the data and be transparent with it is important. So that's why we put a lot of effort in trying to like make sure that we have the best data we can on guarantees, on loans, on furlough schemes, and publish them. Because just like communicated, the amount of help that we're giving to the economy is already like good per se. So transparency should always be the first thing. And I think on the UK experience, we've seen that we've always been quite welcoming of like being transparent and putting the data out there, even if sometimes it was inconvenient. Like now, of course, everyone can see that our approach to like government support is unprecedented, but we still think that like making sure that we're transparent about how much we're giving in terms of loans and other support is important.
Excellent. Thank you very much. Any other comments, reflections? Okay, good. Patrick, can you unmute, please, just to check?
Thank you.
Yes, please.
Thank you, Aman. Yeah. We also have a question from, or a comment from Vicky Rock, who also says, educate your governments and show them the information and make them share your worry on the balance sheet. This is just a comment, which I think is very useful. We also have something from another question, which is how should developing countries behave in terms of social spending or support to business during COVID when US and other large countries are indebted and do not keep reasonable debt/deficit levels? The World Bank also advises on cash transfers and borrowings. Balance sheets do not include ability of the government to generate revenues in the future. In the future, balance sheets and accrual indicators are not also possibly watched by credit rating agencies, and lenders do not have the ability of the government to repay or stroke ownership. It's quite a lengthy question, but I think the basic question is, how do developing countries behave in terms of social spending and support to business during COVID when big countries like the US may not comply with may have high debt levels, which may keep deficits and very high, basically. If I may repeat, how do developing countries behave in terms of social spending and support to business during COVID when US and other large countries are indebted and do not keep reasonable debt and deficit levels?
Sure, I jump in with maybe an initial answer, and I'm quite happy to hear from some World Bank colleagues on this one too, because I feel it is maybe directed to you as well. I think one thing to pick out from the comment there is a really important point that we actually haven't covered in today's conversation, and that is the intangible asset that is obviously not included in public sector balance sheets and the future tax revenues that are expected, etc. And yes, and that could really make a huge difference in terms of looking at what we often see as a negative public sector net worth. And I think that's something to acknowledge and something to make reference to when we do discuss financial reporting. To the question on how developing countries can approach this, actually it's quite interesting to see the comment talking about this in the context of large public debt and deficit levels. So to my mind, this actually takes us back to the initial kind of challenge that we've put here, which is that so many of these interventions are actually sitting outside of traditional current spend. And they're I think it was Costanza, you described this as kind of non-traditional balance sheet responses. And that's going to require this new approach. But equally, it's going to mean that we're going to have a very good view of what fiscal firepower is available to us. So that would only be coming through on our balance sheet information. maybe to one of the World Bank colleagues to elaborate. Dan, I think you're on mute if you're coming in there.
Patrick, we cannot hear you. You're on mute.
Yes, I think I was saying that this is something we can always reflect on and communicate in other forums or through the website. There is also another comment, and I think it is a very useful one from Vicky Rock again, who says that, yes, I recommend the 80-20 rule to focus on high value items that you can clearly determine, as it will be extremely difficult or impossible to get every detail correct. I think this is just to complement on what the presenters have made. Maybe one of you can just emphasize on that matter. Alex, do you want to jump in?
Sure. Maybe just to say, I'm finding the comment here. I think it's a really prudent observation that when we're in a point of crisis right now, and really we're focusing on what Vicky describes as high value items here, and that's a very helpful frame of mind for us to take into how we're making these decisions. What are the significant impacts on public sector balance sheets? I know it wasn't mentioned in the conversation from the UK team who've very kindly joined us, but the production of whole of government accounts is quite an exercise. But let's think about ways in which we can report more frequently. And I think the monthly monitoring of top risks is a really good piece of advice to share with those who've joined us in PULSAR as well.
We also have a question in Russian. I don't know whether, Aman, you can assist with that. It's from AT.
Patrick, where is the question? I could read in Russian and translate. No, it's from Anara. It's just a technical comment. It's not a question.
No.
Patrick, you are muted.
Just in case any of you would like to ask your question, please request to speak as well. As I think we have exhausted all the questions on the chat box. If not, Aman, I think you would proceed to provide your closing remarks.
Thanks, Patrick. Thank you again, dear PULSAR participants, as well as this time PEMP observers and other guests. And thank you to speakers for this very interesting, smart, interactive talk on the balance sheet approach. And we have heard UK's experience, broader global experience. We have learned from ACCA how these approaches are relevant, particularly during COVID crisis. And that was very enlightening in terms of the balance which we were discussing. From one side is those are going down, expenditures are rising. Its impact on the impairment of assets could be significant. So at the same time, the point was raised about the potential for taxes and how we can evaluate all other assets which are not covered in the picture. So this all brings to the discussion that whether there is a need for a balance sheet approach, and the answer is yes, we need to follow with the balance sheet approach for policy decision making, for accurate decision making, for transparency, for intergenerational fairness, and for openness and accountability of the government. So we are clear, our governments, and we are as a support in this function, and as reform leaders in our countries, we can support to shape appropriate policy response based on accurate and reliable information. Thank you for all the participants and speakers, and stay safe, and see you on our next Smart Interactive Talk. Thank you and goodbye.